me see. Hi everybody. Today is April 5th, 2026. We are about to start our fifth video series, Invest Your Way to Financial Freedom. Unfortunately, today we're a little bit behind our schedule, but it's very difficult, managing my work and all the things I'm doing. And unfortunately, I was late today, but I just want to apologize. But thank God, I was able to make it, and we have a lot to discuss today. So, without further ado, we want to continue, to educate people. Just, this series being a journey. Again, this is our eighth video. Today it's April 5th, 2026. This is our series, Invest Your Way to Financial Freedom, where we use a simple framework in which we help people to maximize their income while reducing your expenses so you can get a positive net income. And with a positive net income, what we can do with it, it's part of it you invest in liquid asset like stock, bond, and also in part of your positive net income, you can use it to combine with positive debt to invest in illiquid asset like real estate. So for the one who don't know me, who's gonna be joining us the first time, my name is ElBozo from Combit Group. Our mission is simple. We want to simplify the business and investment world so you can be more educated to financially invest your way to financial freedom. We want to definitely inspire the next generation of investors, so that's why we choose very simple way to communicate to you. No hype, just realistic strategy. Make sure you are like really knowledgeable so you can take your investment journey to the next level. So don't forget to subscribe, follow us. We want to really, at the end, the goal is to build a community of the community of the next generation of investors, so we all can help each other. So like I said, today we are packed. If you are gonna join us, make sure you are ready because we are ready ourselves. Um, we wanna continue talking. Today is gonna be a very, very important topic. Specifically, this is a continuation of what we spoke about last week, which is the fundamental analysis. This is the second video we're gonna have about fundamental analysis. Today is very probably one of the most important the video that we're gonna do in this series. So if you just join us, this is our financial education video talking about interpreting financial report, guys. Like I said, this is one of the most important video of our series. Why? Because I know it's hard talking about, what the step you're taking when you're gonna do the financial report, how to read them, because again, finance language, and regular people who don't know anything about business don't know about the language. So it's very hard for them to really grasp what's going on in the business that they want to invest in. But if you're not educated enough, understanding the basic of interpreting financial report, guys, you're not gonna be able to understand those things. So ironically, a lot of people who knows that I know that investing in businesses, buying stocks and stuff, but they really don't know exactly what they're buying. Because why? Because they don't have the basic information. So before we go, so ironically, that's what happened. So again, when you look at it, those are the information that everybody have to rely on. It doesn't matter if you like the CEO of Chase, like Damien Diamond, or if you are like somebody like Larry Frank, the CEO and chairman of BlackRock. We all got to look at the financial report, guys, before we invest in a company. So that's why today it's very important that you guys, I'm gonna break down most of the concept. Guess what? I know it's hard, and that's why a lot of rich people, that's where they get you guys. If you don't know they make it complex, the complexity of the market, so people don't have the information that they need because it's so complex. Who's gonna have the time to really learn about financial condition, do all the analysis? Nobody. But guess what? That's how rich people do that. Very educated investors, they take their time and read the financial report. And that's why before you invest in anything, guys, you got to make sure you understand the financial report of the company. especially the quarterly report. So if you don't have the time to really read those reports, why you even bother understanding? Why you even bother investing in those companies? Because what? You really need to know the language, like I mentioned, especially, before you invest in a company, do you know their PE ratio? Do you know their EPS ratio? What about their EBITDA, the debt to asset ratio, their return on their own equity, return on equity. Do you know your profit margin of this company? So what method you are using to evaluate this company? Are you using multiple, or are you using discounted cash flow, free cash flow? What kind of method that you're using to really evaluate those before you invest in this company? And that's why a lot of people, they don't, when we're talking about those stuff, which is, I understand, are complex, but still, we still want to make sure you got those basic information so you can take, you know your journey to the next level. So there is no excuse, guys, and there is no shortcut. I don't think when I start my journey in investing, I was not looking for a shortcut. If really like a ultimate formula, I really took my time and understand the language of business, guys. So if you just want like scrolling and looking at just short thing, this is not a series for you. This is a series for people who really like feel like they really want their journey to the next level, but guess what? They understand there is a responsibility to do so. You have to take your time and learn about those financial terms. You got to speak the language of the investors when they're talking about, for example, PE ratio. When they talking about those type of terms, guess what? For common people, they don't understand it. So why bother, learning about them? But guess what? That's what real investors do. They take their time and understand those concepts. So that's why today we really feel like, while it's a very difficult topic to manage in a life, we really want to take our time, at least give you guys the basic, So more we educate the person, more like we feel like we empower you guys, so you guys can really understand the basic term and take it to the next level. So that's why, we are planning also big to do like a we are also planning to do like a definitely we want to do a record a video where we can go through the whole process with you guys, analyzing how to evaluate companies to invest in. So we're not just like picking stock. We are take really gonna go through all this report. Especially we're doing an Nvidia report. We're gonna record the video where we're gonna go through all the things that you need when you're analyzing a company before you invest in. So again, if you really care about becoming an investor, an educated investor, guys, this is the information for you. Stake in the life. You're gonna know the basic. Make sure you like and subscribe. And we are here to inspire the next generation. When I came in investing, guess what? I didn't have nobody. I didn't have no daddy or no mommy to tell me what financial literacy is. But guess what? Over time, when I start learning, when I take my time, I was not just scrolling. I was not looking for something short term. I was looking to really understand the basic. And after learning the basic and start investing, I become a better investor. And I see my portfolio keep going, because guess what? I speak their language now. Now, I cannot, nobody cannot just tell me something about a company, because I'm taking my time to analyze their financial report. So that's why this is the video for you guys. If you really want to take our time, please stick with the live, guys. Share it, because this is like prime information that rich people don't want you to know. They don't want you to know about those information because they make it so complicated. And our goal today is breaking down those terms. So stick with us. Make sure, if you have already, make sure you follow us on YouTube, ElBozoBonsando. And we are here every Sunday night, guys. I do my best every Sunday night, 8 Central Time. We're here to make sure we educate you guys. So without further ado, we want to make sure we continue our series. Again, today is the second video we're talking about fundamental analysis. If you haven't learned about those concepts, guys, we already got so many videos on YouTube. You can go and look at them, and make sure you take your time and break them down so you can have the information you need. So as our regular format for this series, we usually talk first about what happened this past week. So we go an overview of it, and we also give you information about what you look for the next week. What are you looking for next week when it comes to financial information? Because guess what? If you're in the market, you want to make sure you are following the information, where they're coming from, what are reporting. Especially we want to make sure what the war. There's a war going on right now. We want to make sure you understand how it affects you, and that's why we're going to discuss today all those things. We give you all those information. And also part of our series, we also give you the twist stock. We share with you the twist stock that's doing well in our portfolio, so you can maybe we cannot tell you to invest in those companies that we share with you, but those stocks are the stock that did well for us for that week, so you can look at them. Maybe this is like you do your own research and see if those stock fit your investment strategy. So yeah, without further ado, for the past week that's just coming up, we have the stock market rally. As we notice, the stock market rally this week very high. So definitely is because of based on the news of Donald Trump. He wanted to end the war about like a 2 to 3 weeks. So that was a good news for investors. In the investing community, we welcome those type of news, because nobody at the end of the day, the more this war lasts, the worse it is for us. More inflation, more problem with oil. But guess what? While we welcome the idea of ending the war by Donald Trump, but as I mentioned in my YouTube short this week, um, one of the problem we have right now is the Strait of Hormuz. He wants the Strait of Hormuz to stay remain closed because there is a lot of difficulty to even open that strait. Iran still resisting, guys. So that's become a problem for us investors. We still want the Strait of Hormuz is to open, because guess what? It's 20%, more than 20% of oil, of the global oil that's stuck in there. So oil price might remain high or even get higher, because guess what? Right now we're on the 36th day of the war. The oil gas price, an average in the United States, about 4 to 4.10 cents a gallon. The oil crude oil, which is what we measure in the US, is 11. Let me see, $111 a per barrel. So that's like really high. It's continued to be up, guys. So we don't see, if in case the Strait of Hormuz remain closed, we don't see this price of oil going down anytime soon. He might go a little bit down, but the tendency might be that it goes up. And guess what? More oil gas prices, like we have been mentioning, is become a problem, because now you got more inflation, everything gonna go up, transportation good, and that's gonna cause a lot of fear, a lot of problem in the investment community. So it's not good for anybody to have oil up and have the war last more than it's supposed to be. So personally, I one of the good things I heard this week, especially over the weekend, one of our pilot, the U.S. pilot that was missing, finally they found him, which is a good thing for us, regardless, how we feel about it, about the decision going to this war with Iran. But we, us as investors, as U.S. investors, we are happy that our military members are just doing their job, guys. They finally get this guy back home, and this is a positive for us. So we welcome that news, and hopefully, all our military personnel that out there serving this country, they are safe, and we pray for you. And if you are a veteran in the life, or if you have a veteran, or any military personnel in your house, we salute you and we say thank you to your service, guys, because we want our service people to be safe out there. So without further ado, we want to also continue by saying, as this continue, like going on, there's still, Fed still turning more cautious, because the Fed rate still about like 3.5 to 3.75%. So it's still higher than inflation, still higher than the Fed rate. So target. So we have higher inflation still, and Fed is signal no rush to rate cut, so that's the problem. When you have inflation like this, there is no need for the Fed to cut rate. And mortgage rate still rising again because mortgage rate jumped to 6.57%. So it's impact housing, slowing down risk, consumer spending under pressure. So definitely we see a lot of inflation risk in the market due to this war, inflation related war. So again, as we say, oil shock, you have new inflation wave risk, inflation already above Fed target for this year. So rate is not being cut, inflation might stay high again. So when Fed doesn't cut the rate, it does not good for investment. It will slow down the economy. So we want as investor the economy to go up. So definitely we're looking for those type of problem in the market. And now for next week, we want to look at, there's a lot of report that's coming out there. For example, the CPI report is coming. This is a big one because guess what? This is the first of CPI report that's gonna be coming out this during the war period. So it's very important. So we're gonna see what's the market reaction gonna be. If we have a higher CPI, definitely it's gonna affect the stock market. It's gonna put more pressure on the stock. If you have a lower CPI, you're gonna see the reverse. So those indicators are very important for us investors as we go through the next week. And also one of the things also we're gonna look for next week is earning season. Earning is begin again. It's another earning report season for the first time during the war. So we're looking at airlines companies. We're gonna be looking for especially for Delta Airline. Delta Airline is gonna be reporting, for example, next week on Wednesday. See, how they do, what is the profit, is profit under pressure, is the transportation cost is rising. So we want to see if that reflect already in their transaction, in their balance sheet. And also we have consumer brands like Levi's. I know Levi's is reporting earning on Tuesday. So those are like, it's just telling you how people are spending. Is there people are cautious? So definitely we want to see what's going on with the retail, investors, with retail investors, what they're saying based on the report are going coming from those companies. So definitely this week is going to be an important week to look out for earnings coming up from techs and all the sectors. So definitely because it's the first report from the first time of the war, so they pay close attention to that. And for our three best stock for the past week, the first one, it's Aura Material. Its ticker is AUGO. So this is our, I think like this is so far the third week this stock being our best stock. It's up 31% this past week. It's a Canadian multinational, what they specialize on gold, copper. So we are investing into material, especially during the wartime, guys. When you have inflation and all the stuff, those type of company like gold companies, they tend to do well. So that's why, as investors, we are diversifying. We are looking for where the money is at. It's definitely a material is one of the sector that we are investing in. And based on the rally this week, we see like a company like Syndic, the ticker is SNDK. It's up for us 16% this week. So it's one of our best stocks so far this year. So definitely it's up 16% this past week. So we're very happy with our position in Syndic so far. And also the third stock we want to share with you, it's York Space System. So this stock for this week, it's about 34% for us. Again, every week we share with you what are the best stock in our portfolio, so you can look at it and then see if the stock is something that's gonna fit in your portfolio. So as you see, so part of the market still profitable. We still got sectors that, we still see sectors that still profitable for us while we're on the market. So those are the sectors we still want to be paying attention to. Okay, so now let's go through our topic for today. Our main topic for today is how to evaluate companies. Guys, I mentioned before you invest in those companies, do yourself a favor, know how to evaluate those companies. That's what we're doing today. Imagine you're investing in a business. At the end of the day, before you buy it, you have to make sure you do your financial analysis. I can tell you, rich people create a complex system that regular people will be discouraged to understand. So they don't even thing. So how are you gonna just invest in things that you don't even know what are you investing? And that's exactly why a lot of people don't even bother to invest, because it's so complex. And our mission is to break down the evaluation, how to decide when to invest. So that's why if you join us right now, you don't know about our series. We here every Sunday, 8 Central Time, where we talk about financial literacy, how to invest. It's all about investing. No hype, guys. It's definitely, we want to make sure you got the information that you need to take your investing to the next level. So when you went through the importance of doing analysis like this past week, we already talk about how to do the type of financial analysis. So make sure you review that video, guys, because this is a continuation of that video, because we're talking about question that you want to ask yourself before you invest. For example, so good of the company performance. If this person is the company profitable, that's how you learn how safe it is to lend money to this company. Because at the end of the day, you buying a business. How financially rewarded is to be a shareholder of this company? How much value does this company provide? You cannot answer if you cannot answer this question by just like simply looking at numbers separately. You have to you got to look at the bigger picture and put everything together. You have to use ratio in the sector. When we're talking about business finances, we use ratio, and ratio is one of the language that we use to compare companies between the company performance. Because sometimes we might just have to just not look at the company as an individual, but also we have to use compare that company to other company in the same sector to determine if this company is doing better than the other. So now, are you looking to understand financial report of the company, or multiple companies to determine which one to invest in? So that's what we're trying to determine tonight. So in a simple term, financial report tell you three things: how much a company make, how much is keep, and whether it is strong enough to keep going. Tell you need to decide if it's a good this. By doing so, it's you become familiar with, is this company is a good one to invest in or not. Ironically, this is what many people are not doing, especially all the retail investors or just beginner investors. A lot of want to just picking stock and they say, oh, that's they investing. But I can tell you, definitely that's not really investing. If you're just picking stock, that's not really investing. You got to make sure you do an analysis, especially the financial information, the financial report. You got to take your time and do your analysis of this financial report in order to really understand and decide if you want to invest in this company. And that's why we use ratio, guys. Ratio, especially our language of business and finance people love them. Ratio make the numbers make meaningful, and you can use them well to compare companies. So definitely you want to make sure you're familiar with the ratios that those people, because if you're watching any, for example, any shows like, let's say, Yahoo or Bloomberg, any shows around, if you're watching it, you're gonna see they throwing all those terms out to you. But if you don't understand them, what does make sense, to even invest? So that's why we use ratio. When you start learning about the ratio that they use, the language that those business people are using, you become knowledgeable. You speak their language, and that's how you build yourself as an educated investor. And that's what we're here for. We are not here for people just calling. We're here to tell you exactly the basic information that you need to take your investing to the next level. I can tell you, when I start this journey of investing, I didn't know anything. I didn't have nobody to help me. And I had to do all the work. And that's why I have the mission. I do myself that mission that I don't want nobody else to go through it. If I can be that difference in somebody's life to make sure they have the basic information so they can become wealthy, take their investment to the next journey, I'll be more than happy to do so. And that's why we here every Sunday, guys, 8 p.m. Central Time. And we're gonna dive right into it. Especially, for example, before we start, we're talking today. Remember, we're talking about the evaluating financial report. So the three main thing in any financial report are income statement, the balance sheet, and the cash flow. So any company, especially in the US market, they have three things in common when we look at their report. It's an income statement, a balance sheet, and a cash flow. Now we're gonna go through all the three component of any financial report by the following. First, the income statement. What we learn about income statement is mostly the performance of the company. It's also called the profit and loss statement. It's one of the core financial report in accounting, especially. The accounting love this type of report. It shows how much money a company made and spent over a specific period. So either quarterly or yearly, or whether it's end up with profit or loss. In other words, it shows how a company realized net profit after taking account all its revenue and costs. The main component is revenue, expenses, which give you the net income. It tell you what is the company is making money, but that's not all, guys. That's not all. The main component of the income statement, you're gonna have to break it down, especially the top line. When they're talking about top line, they're talking about revenue. What is the total money earned from selling product or services? That's it. What is the money they're making just by the service or product they're selling? If you look at, for example, a company like Nvidia, it sells GPUs. This is all sell income. First thing in, so that's the revenue is the first thing any investors will look when you start analyzing a company, because you want to make sure the company is making money, plain and simple. The second thing in an income statement you look at is the cost of goods sold. So it's the direct cost to produce the product, material, or labor. So that itself is the cost of goods sold. The formula is the revenue. So with that formula, cost of goods sold, you want to make sure you look at the gross profit. The gross profit is the revenue minus the cost of goods sold. So the gross profit, what is entail? So the gross profit is the profit after produce cost. It shows basically profitability before overhead. So a strong gross margin equal pricing power or efficiency. So this is like the very important thing I wanna re-emphasize. When you look at companies that are making money, you want to make sure they're not just doing revenue, guys. You want to make sure very well that you are paying attention to their gross margin, profit margin. So a strong margin saying to you this company is pricing power, it's efficiency. Because a lot of companies out there, for example, I know companies like Amazon, for example, they have a lot of revenue, but when you look at the nitty gritty when it comes to the net income and gross margin, that's when they start lacking. You will see, like, oh, they're not really making a lot of. Very educated investors start looking at those stuff. They focus not just the top line, but also the bottom line. So you want to make sure they're making money, but also they're retaining the money, which is the gross profit. And I can tell you, when you look at this the gross profit, and in different term, it's definitely what they call EBITDA. So the gross profit has to do with EBITDA. So it shows how profitable the core business is. Why? Since every company has different. So one of the concept that we definitely want to talk about is that gross profit we relate it to EBITDA. So it's the earning before interest and tax and depreciation and amortization. What is it like when they talk and when they evaluate companies? We definitely want to see that. You're gonna see people talking about EBITDA, and what is it? It's definitely focused. Is focused mostly on cash without like outliers. So the EBITDA is considered as the ultimate measure of the cash generation by operation. So it is an important indicator to understand because a lot of those big companies may have a lot of EBITDA. So it is very, very important. That is why you cannot just use only one indicator to analyze the film, but also you use them part of the story because you want to generate a lot of people who generate gross margin, but still they will use a lot of taxes. They if you look at their last the amount of money they're making at the end, a lot of time they're not doing it because they're operating well. They're doing it because they taking cash from tax, for example, tax break and stuff like that. So that's why when you're looking at gross margin, EBITDA is a component of the gross margin because it's so important because it's only showing the net profit. So with that net profit is from operation, which is different from the last net income that if you're gonna calculate, if you want to see net income that have to do with taxes, interest. So with using EBITDA, the earning before interest, tax, and depreciation and amortization, you look at what the company is doing before all those components. So it's mostly cash from operation. One other component also that you look at a from the income statement is the interest expenses. So cost of debt, you want to look at the loans, the bonds that those companies have. And also you want to look at the taxes. And as the bottom line, like I was mentioning, you're looking at the net income, the financial profit that all expensive after all expensive. Is that if this is that's what shareholder care about? The shareholder care about the net income. They don't care about how much money you really make. They care about how much money you're retaining. And that's the net income, which they call the bottom line. That's what we care about. Is this company actually making money at the end of the day? That's what the net income tell you, and you get that from the income statement, which is very important. So key metric derived from income statement, especially we want to look at the EPS, earning per share, profit per share of a stock. It's an important evaluation, guys, that you want to make sure you understand. When you look at the income statement, look at their earning per share. And we also put emphasis about the profit margin. So it's sometimes referred to accountability margin. Is the financial ratio that measure the percentage of profit earned by a company in relation to its revenue. So the gross margin equal gross profit over revenue. So the net margin is the net income over revenue. Higher margin, better efficiency. So we want to make sure we are looking for higher margin from those companies because a lot of companies are making money from their sale, but they're not retaining money. They may spend too much. So we want to make sure those are making money by having a gross profit. So now the second component of any financial report is the balance sheet. You hear this term a lot, balance sheet. What is balance sheet? Balance sheet, it's definitely what you look at the company asset, which means what they own, what is owned, and liability, what people own them. So it gives you what we call the equity. If you look at when you take your asset minus your liability. So your asset, I think I explained this before, guys. Your asset is what make you money, what generating money. Your liability is what taking money off you. So your equity is what left between what you have, money you have, and the expenses you have. What left is your equity as an investor. It tell you, is the company financially strong or is just joining in debt? That's why this is very important. So this same, always there is gonna be a balance in this equation, because it have to be always balanced. At its core, it follow the fundamental equation, which is asset equal liability with shareholder equity. This must always be balanced. That's why it called a balance sheet. So what is the main component of a balance sheet? We mentioned it: the asset, what the company owns. This is resources that provide future economy value. An asset that's less than 1 year, you got cash, cash equivalent, account receivable. And one term, this is one term that you're gonna hear a lot when they're talking about account receivable. This is like, think about things that you should receive. It's part of your asset. Inventory is part of your asset. Short-term investment, property, plants, equity. So all this thing is considered part of your asset. So what to watch? When you're looking at the asset, you want to look at, is cash increasing or decreasing? You know, is the inventory going too fast? Possible weak sell. So when you look at, definitely look at on the asset, you want to look at inventory. How fast the turnover, how fast the inventory is being transformed into cash. So are receivable rising faster than revenue? In this case, it will indicate a collection problem. And also under balance sheet, you want to look at liability. Obligation to orders, for example. Current liability, you have account payable. This is what the company have to pay. You have short-term debt, long-term liability, leases obligation, etc. So those are like things that the company own called liability. So what are you trying to understand is debt increasing faster than growth? Can the company cover short-term obligation? So is there any high interest burden in the company? Is the company more? So with high interest burden, then you're gonna have a lot of risk. Then when you're looking at the balance sheet, one of the things also you want to look at is the equity. What is the equity? Is the net worth. Equity is the shareholders. What left after liability are subtracted to asset. You want to look at the common stock, retained earning, additional pay in capital. So what to watch? Are retained earning growing? Healthy business. So if they have high return earning, so that's when they're going. Is equity shrinking or not? If you got equity is going down, that's mean it could signal loss or buyback. So it depends, how. In general, what you're looking into when you analyze a balance sheet is the company liquid, short-term health. Can the company survive in the next 12 months? So that's why you really understand, make sure you understand the current ratio, which is the current asset over current liability. If it's one, if you look at the current ratio, when you do that, if it's one, it's equal safe. If it's under one, it's potential risk, might be a lot of risk. So the debt level, you want to see the financial risk, debt and equity ratio, which is equal total debt over equity. It could be, if it's too high, debt is too high compared to equity. So that's mean it probably a very risky company to invest with in. So now, overall, you definitely want to look at increased debt without increased revenue. It's too much reliance on borrowing. Asset efficiency. If that company using asset effectively to generate revenue. So a red flag when you look at the balance, weak revenue growth. And also if you look at rising inventory with flat sale. So if inventory is growing, that means they're not selling enough. This is not a good company to look for. So that's why when we're talking about those things, guys, I know it's very difficult to grasp those things, but the basic understanding of those ratios, and that's the language that's the language of business. Unfortunately, it's as complicated it sounds, it's the language of business. So you want to make sure you understand those things. In the balance sheet also, we're looking at the quality of asset. Not all assets are equal. Is this cash, very a lot of cash? It could be a strong thing to have a lot of cash. A lot of inventory, like I said, risky. So because should, if there is a large intangible asset without clear value. So definitely those things on the balance sheet, you don't want to see them. You want to look at the trend over time. Don't analyze just 1 year or compare to 5 years. Looking at growth in asset and equity. Stable, that means stable. The red flags definitely you should avoid. Negative equity, rapid increase of receivable, inventory pulling off, healthy reliance on short-term debt. Definitely, you wanna, at the end of the day, what you're trying to determine, can this company survive the next 12 months by having enough? If the company doesn't have enough cash to run to pay this debt, definitely it's not gonna survive. So you do that by looking at the balance sheet. While the income statement tell you is the company is profitable, but guess what? The balance sheet is definitely tell you if the company will be able to survive in the few months or year. So that's why when you're doing your analysis about those companies, you cannot just take one part of the report or one ratio. Every part of the report is telling you a different story, and it's like, I don't know if you guys play a puzzle. So every little things matters, even though every part is different, but they still matter in the bigger picture. So that's why when you're doing your analysis of this company, you want to make sure you look at all the components of those report. And that's what we do here. We want to make sure we give you those information so you can see this is not one part. For example, if you say, okay, the income statement is very good, wow, the company is making money. But when you look at the balance sheet, it's telling you, oh, you have too much debt. So that's mean, are they gonna be able to pay all those? You don't look at the balance sheet, you just look at the income, you see good money, and that could be a problem. So that's why you got to make sure you look at all the components of the financial report. So we are moving on now. We're looking at the third component of any financial report, which is the cash flow statement. What is the cash flow statement? It shows real money moving in and out of the business. Unlike profit, which can be manipulated, the cash flow tell you what cash in, what cash out. Is the company actually generating cash or just paper profit? Trust me, there's all this company out there. They have different, like a lot of ways to show up that they're making money, but they're not having a lot of cash. So that's very important. we, I want to take a break right now to kind of explain the concept of cash flow, because a lot of those companies, we see a lot of companies who come out with their report, they have a lot of cash, and you say, okay, having a lot of cash is good for a company, but guess what? There's different way we as investors we interpret when a company has a lot of cash. For example, Berkshire Hathaway, which is the company that was the chairman of was Warren Buffett, right? That he created. That company come out with a bunch of cash on their report. But guess what? Having too much cash in your report is not even good, because there is different way we can interpret having a large cash. For example, first we can say having a lot of cash is an insurance policy during a certain time. So that's mean, the company is healthy, the company have cash, and it's kind of be giving the company credibility. But also, that also can be interpreted, okay, since you have a lot of cash, guess what you can do? You have a lot of power to invest in future opportunity. Let's say if something come up, the company have cash to deploy for new investing. But also, we see that very much in a lot of those companies when they come out with a lot of cash in their report. Some investors will be cautious. The stock will go down. Guess what? What they worry about is if there is a absence of investing opportunity in the company, because investors don't want to see that you're not investing the money, because they always worry that cash sitting there pile up is not generating anything compared to if you invested. So just because a company go out there with a lot of cash in the balance sheet, that doesn't mean investors want that. As a cautious investors, you might want to question, hey, why the company is not investing? Is there a lack of opportunity out there for those companies? And that's when it gets tricky. So definitely too much cash is not good, because that cash is sitting there and investing is not investing it. My interpreted a lack of investment for that, definitely for that company. And we see that all the time, guys. Company like come up with a lot of cash and then they still their stock go down and investors still put up, because they don't want that. They want the money to be investing. So that's the also a lot have to do with the balance, guys. Not too much. Everything in excess, it causes problem. So now, what are the three main components of operating cash flow? So for the three component of the cash flow report is you have operating cash flow, investing cash flow, a financial cash flow. Now let's talk about operating cash flow. Operating cash flow is the core of the business. What it is cash generated from normal operation. You sell, providing the service that you're providing. So this is like the operating cash flow. This is just purely business. How to interpret it? This is the most important section. Is it positive? Is it growing? So if you look at the company to grow, if you look at this growth stock, you want to make sure that operating cash flow is solid. Definitely a strong operating cash flow, for example, in the case of NVIDIA, it signal that there is a lot of demand for their product, for AI and stuff. The red flag is profit are high, but operating cash flow is low. So that would be a warning sign for a company. If your profit is high, but your operating cash flow is low, definitely this is a red flag. So another things to look in the cash flow statement is investing cash flow. Where the money is going. What is it? Cash used to buy equipment, data centers, technology acquisition. How to interpret an investing cash flow? It's usually negative, and that's okay because company is investing to grow. So the investing cash flow, usually you don't see it. If it's not positive, we still be cautious. We still like really look if it's too much. Is it too negative compared to other companies? But if it's negative, that's not a problem. So in case, like we say, investing cash flow, a good sign is negative, interpreting that cash flow is investing that money. So the red flag is a huge spending and then no growth result. So if you have a big investing cash flow and then there is no growth, there is no productivity, so then that's a problem. So again, when we look at the cash flow, one of the things that we want to also look at, the third thing we want to look at in the cash flow statement is the financial cash flow. How do they find the money? So where the cash flow is coming? Is it coming from debt? Is it like from issuing stock? Is it paying dividends? Is it stock buyback? So you want to make sure you understand the financial cash flow. How to interpret it? It shows how the company is financing itself. A good sign is share buyback. And when the company is buying their share back, in general, it's mean confident. They're confident in their company. if the company is paying down debts. So definitely those are important indicators that's saying that the company is healthy. And you see that in the financial cash flow. And one of the red flags, for example, consistently issuing new share. That's called dilution. So if you are owning a company and they constantly pumping share out there, so that's not good. It's affecting your share value. It's increasing. It definitely, if you also see them increasing debt to survive, so definitely you want to make sure on the financial cash flow you're really looking at their debt, what they're doing with their debt. If they're accumulating too much debt, guess what, my friend? This is not a company to keep investing in. So if you are, I want to say thank you for everybody who is in the live. If you just joined us, we are definitely deep into the conversation how to invest, how to evaluate the company you're investing in. Make sure you like and subscribe. And we are continue to really this series, guys. I want to make sure you understand this series is for people who really serious, taking it serious about investing. It's not for people who are scrolling and then just looking at a formula, something I'm gonna tell you and then change your life. This is not it. This is for people who really want to take their time to really understand what are the how to interpret the business, the financial report of the business they are investing in. So now the most important in summary, the most important metric to look at in the free and when you look at the cash flow a segment is the free cash flow. That's a concept that's mostly what the investors focus on. The free cash flow is one of the most important metric in investing because it tells you how much the real cash a company actually have left after maintaining its businesses. The formula of the free cash flow is operating cash flow minus the capital expenditure. So what is it, the cash flow? What is it exactly? What after the company generating cash from operation, paid to maintain expenses in business, what left from that is the free cash flow. This is truly the operation. This is the cash, truly the operation of a business. If we move from cash charge like this, depreciation and amortization, it is the pure measure of cash and the basis of evaluation. So a lot of people who are investing, they are looking at free cash flow at the ultimate indicator how a business is doing. Why does it matter? Because money left after running the business, it can be used for growth, dividends, or buyback. So definitely, if you look at what the company have left, they can do a lot with it. So for example, Nvidia, they have a lot of free cash flow. They can invest in AI and still have extra cash. So that means the company is healthy. The AI venture it continue, guys. The AI trade is continue. If you look at what's going on with the balance sheet of Nvidia, even though they're slowing down a little bit, but again, having a lot of free cash flow, it's a good thing. And whether you having a lot of free cash flow than having not having free cash flow at all. So simple investor checklist. So a simple investor checklist when you're reading cash flow is asking: is operation cash flow positive? Is it growing over time? Is it the company reinvesting wisely? Is free cash flow strong? If they're under control. So those things definitely, those are the questions you want to be, you definitely want to like looking at it when you are looking at free cash flow. Quickly interpretation, you want to make sure you have operating cash flow and financial cash flow is going up. That's mean a smart investment, healthy and growing. But when you have a mixed signal, it's because if profits is going up and cash flow stay flat, watch closely. This is a warning sign. But now, and the dangerous side is if profit is going, but cash flow is negative or going down, there's a problem here. It's possible accounting illusion. Definitely the company might not be making money, guys. Definitely, if cash flow is negative, but you see profit is up. So there always gonna be a dangerous situation here. So cash flow tell you if the money is real, not just number on paper. So two way to evaluate a company. So there is like, so people who are looking at ways, ultimate ways to evaluate a company, guys. There is two ways to evaluate a company. It could be, so the two ways to evaluate a company, guys. Company is first you using what we call the multiples. The multiples is when you use all those, a term like PEs, EBITDA, and EPS and stuff like that. But another way to evaluate a company is when you're looking at what they call discounted free cash flow. So that's another way to evaluate when you're using discounted free cash flow is when you're saying, okay, today the company is making money, but what's going to be the value of the company in the long term? What this money today represent in 20, 50 years? So that's what they use. They use complex equation to determine what's going to be the free cash flow, discounted free cash flow of the company in the long future. But if you're using the multiple method, that's mean the multiple method, what you're trying to determine is just almost comparing your company, how profitable they are compared to other company. So that's why you have to make sure when you're doing your evaluation between the different companies, you want to make sure you use different type of measurement. It's not just one measurement that's ultimate goal, but you still want to use different method to combine them, and every method give you different a perspective on the company you're investing in. So what is the key difference? Multiples, the key difference between multiples or discount free cash flow is multiples tell you what is the market is paying for a similar company. But if you look at discounted free cash flow, it's what is the company actually worth based on its future cash. But the only problem with discounted free cash flow is because you are trying to predict something in the future. That might not be the case, but it gives you a little bit of, some people might use it better to kind of have it take it more like a future perspective, which can be like, I'm investing in something for long term, so I'm not investing now type of a method. So definitely you want to be familiar with those two type of technique that you want to use when you're doing evaluation for your company. So now let's recap. Obviously this is a lot of information, guys. I'm sorry, but this is what you need to know. Those are the things that a lot of people, or all the real investors, they are sitting there and analyzing financial report. We have to make sure we give you at least the basic information. Now you can take it, you can digest it, you can be more educated. At least you got the basic to invest. So let's just recap. When you're looking at the financial report, we went over to the three more component, the biggest component of any financial report. But now we want to recap for you. Just give you like a quick checklist of what things that you have to keep in perspective. First of all, you want to make sure you check revenue, right? We talk about that. Revenue, you say it's a growth engine. It's what they tell the company, at least if you are making money. Guess what? If the company is not even making money, why even buying? Why even like having a company? So if you look at companies like, for example, Nvidia, you look at their company, the company revenue itself, it's very strong. So that's mean strong demand for AI data centers. So that's important. If it was flash or declining revenue, so the company is not making money. So investors in general, they want to see strong revenue, not random spark. They want to see the revenue of the company is going up over time. And you look at, the second thing you want to look at is check profitability. Is it like looking at, if you're looking at profitability, what are the indicators you want to look at? Is the net income strong? Do you have profit margin? If there's good profit margin there, ask if the company actually profitable. So that's what those indicators are telling you. A great company did not just go, it become more efficient over time. So you understand the the profitability have to do with just like how much resources you're using. It tell you, how efficient you are using those resources. One other thing you want to look at is analyzing the EPS, which is earning per share. We talked about that, last week. We're not gonna go deep into it, but for the people who don't know what the earning per share is, it's a measure of the company profitability by dividing the net income by the outstanding share. So, what you want to look at when you looking at the EPS, you want to know if the EPS is growing year over year. This is what you earn as a shareholder. So the key is rising EPS shows strong investment signal. So definitely you want to invest in a company that have a strong EPS. Other factor to look at, like we talk about it already, look at the cash flow. This is for a lot of investors, is the most important thing for many investors. Many investors ignore this because they want to growth. They want to look at the growth, but they don't want to see the cash flow. But if there's no cash, the company gonna go out of business. So you want to make sure its cash flow is positive. Is it growing? A company can show profit, but and still go bankrupt if cash flow is weak. So that's why it's so complex, guys. The financial landscape, because look at it. If you look at a company, they're making good profit, and you're like, oh man, that's great. But guess what? They don't have no cash. They're gonna run out of cash, and guess what? In a few more months, you will receive a mail saying we will go to bankruptcy. So why invest in a company that's doing bad for the first place? Now have no cash. So a lot of people take in the trap on this because they looking at the short term. They're looking at what the company generating now, but they don't see long term. And free cash flow, having free cash flow in reserve, there's very an insurance policy for any problem going on in the company. The company might really can survive. So definitely you want to know where to understand when you're looking at doing your evaluation. You want to look at where the money come from. Break it down. What is the business segment? What is the revenue sources? For example, with NVIDIA, data center AI equal main driver. So this is like the main driver for them. So if in NVIDIA you see a lot of revenue from data centers, so that means a good thing. AI is booming. But if their data center is not generating a lot of money, so definitely that's going to be a big problem. They do have other sectors like gaming, but it is still small portion of the revenue. So I'm not saying like one segment is more important than others. You want to see all segment is making money, but if it's a smaller segment not making money, but the big chunk of the revenue is from one place and it's doing well, at least you know that that segment is working well and you can go and hold on to it. This tell you exactly when you break it down, it's tell you exactly what driving the growth and is it sustainable. One of the things that you want to check is you want to check again, we talk about this, check debt and finances healthy. Ask yourself what is the total debt. You want to see the debt to equity ratio. This by doing so you can ask if the company can survive a downturn. So plenty of cash. So definitely you want to know a company that have too many debt, they can't even sustain themselves because all the profit will go to paying the debt. So definitely you want to read management commentary. So that's when like you look at the CEOs, what they're saying about the company, why results change, future expectation. You look at the growth, risk, and industry trend. So definitely you want to look at that. And while you're doing your analysis, risk is always something you want to take in consideration. What could go wrong? Example, competition. You want to look at regulation, market slowdown. So smart investor think, where can this fail? Definitely you want to look at the cracks, in the company. And if you're not doing if you're not analyzing the financial report, guys, you can't really look at the risk. You can't really see the cracks. So that's why having a solid knowledge and analyzing financial report is the most important skill you can have, guys, as an investor. I'm sorry, but you have to read your financial report. There's no shortcut, guys. You know, so definitely you want to look at, compare what the report saying right now compared to what is being in the past. So never look at one report alone. So definitely you want to look at quarterly after quarterly, year to year. What you are looking for is trend, not one-time result, because you want to see the company is going up. But if you look at the trend, comparing the company, and then you see the trend, last report was good, this report not good, you already have a red flag right there. So you want to pay attention to that. So the simple framework to remember is, when reading any report, is asking again, is revenue growing? Is the company profitable? Is EPS is increasing? Is cash flow is strong? Where the growth coming from? What are the risks? So we're trying to summarize it for you guys to make sure you guys understand this concept. Pro tip, don't just read numbers, connect the story. Example mindset, we want to make sure all the puzzles come together, guys. It's not just one part of the report. You just quickly look at something and then you learn. No, that doesn't work like that. You have to understand the whole picture, because every part of the report is telling you something different, and you don't want to miss anything. So for now, we're gonna stop it for now today. So it was a very long, I know it was a very long video, and there's a lot of information we throw at you. And that's why we're gonna do next week. We're gonna try to have an NVIDIA report where we can go through all the report together. That's not gonna be a live video, guys, because it's very challenging to explain all those concepts in a live video. What I will do is, we're gonna put online on our YouTube page. If you're not subscribed, please do yourself a favor, guys. Subscribe to our YouTube channel. Make sure we're gonna have this video coming out next week, where all the stuff that we talk about, we're gonna have the NVIDIA report, the last quarterly, and we're gonna print out all those things that you need to understand, because it's easier to go through it with the report in front of you, so you can print most of the important things. So that's why we encourage you guys to follow us on YouTube and stick with us here in TikTok. If you're on TikTok, make sure you join us on YouTube too, because on YouTube we post a lot of our long-term plans and long-term videos. So definitely, as an investor, we encourage you guys to stay with it, stay invested, learn the basic, guys. So we'll give you all the fundamentals that you need. At this point, this is the second video on fundamental analysis. At this point, you should have all the basic information that you need. Try to understand them, break them down for you to take it to the next level. So next week, while we promise we're gonna come up with a recording video on our YouTube page, where we're gonna explain everything based on a NVIDIA report. We're gonna analyze that report. But that video will coming up soon. Make sure if you subscribe to our YouTube channel, you'll be able to see it. So for next week, we're gonna switch to what we call technical analysis. What is it? It's mostly like reading charts. It's day trading. It's what a lot of those people do when you day trade. They call them last time. As a technical analysis, guys, you're not really concerned about how much money and all the stuff. What it's telling you is, when to buy, when to get into the stock, when to leave. You're not worried about what the company report and all the stuff, which is what you should be doing if you're a beginner investor. This is not, technical analysis is not for people who don't know anything about stock, who don't know anything about business. But we still have to talk about it in this series, because myself, when I started as a fundamentalist, which is we understand, we talk about the financial report like we just did. But now, after you understand the basic, what to analyze and how to invest, then you can transfer to technical analysis, which what the day trader do. But with a good knowledge in fundamental analysis, you will be a better technician. You will learn trade, how to make day trading better for you, because you understand what's going on, not just like when to buy, but what is the best stock to buy. So definitely we don't advise day trading for beginner investor, but we do encourage people to start fundamental analysis and then you go to technical analysis. That's why next week is going to be very important. If you're into day trading, if you want to start day trading, I think enough to learn about business, because this is our series. We already talk a lot about fundamental and business. I think if you're a follower of us, if you've been reading this series, you should be equip yourself with all the fundamental you need. You should be ready now to transition to technical analysis. That's what we're doing next week. So we'll see you next week. It was a pleasure, guys. Thank you for staying with us. We'll see you next week, same time, same place, 8 p.m. Central Time, Sunday. All right. Bye bye. Have a good one.